Communitech is working hard to bring new businesses virtual as much as possible while also supporting our members the best we can. Good afternoon, everyone. Thank you for joining today's Ask Me Anything session. My name is Christina Wood, Director of Start and Scale Programs at Communitech, and I'm very excited to have Jagruti Bhikha from Communitech Growth Coach and Angel Investor, as well as Skyler Fernandes, founder and partner of VU Ventures in Silicon Valley, here today to answer all of our questions about early stage investment. Before I turn it over to Jagruti and Skyler to further introduce themselves, I have a few housekeeping items I'd like to share. Just a reminder that this session is being recorded so that it can be used as a resource for our companies to access at a later date. And you can find all of our AMA recordings at communitech.ca. I ask that you please keep your microphone on mute during the session and use the chat functionality to ask any questions that you have. We do welcome questions throughout today's discussion, so don't feel like you need to hold your questions until the end. Jagruti and Sky have assured me that they're hoping to answer all of your hard and tough questions and keep things quite casual. So please feel free to put those questions in the chat throughout today's session and don't take it easy on them. If you'd like to connect with Jagruti after today's session, please reach out to your Communitech CSM or advisor. We do have investment readiness programs at Communitech, and we're able to help you, but the best way to get started is to reach out to your advisor or CSM. Lastly, please check the Week in Tech or the Startup and Scale Up newsletters for a list of all of our upcoming AMA sessions. And with that, I will turn it over to Jagruti and Skyler to further introduce yourselves and give a bit of background. Thank you.
Jags is on mute.
Unmute would help. Thank you, Christina, for having Sky and I. We're really excited. So we both are coming from non-Canada, so US, your partner in the South. So I'm Jagruti Bhikha. I've been in tech for 27 years and been an angel investor for last 8 of them. I've done 50 plus investments myself and some of them with Skyler, and really excited to help early stage, seed stage companies answer some of the questions that you may have, just, getting another opinion or whatever it is that you feel that you need an answer around fundraising strategy, investment, etc., approaching investors. And we are hoping to give you another perspective from Silicon Valley, as well as, Skyler can tell you more about, he's all over the world, but I'm based out of Silicon Valley. And with that, I'll hand it over to Sky.
Cool, thanks, Jags. And Jags and I have been working together now for, I guess, about 2 years at my fund, VU Venture Partners. So I've been doing venture capital now for a little over a decade. Have invested in over 100 companies. Between myself, my partner Andrew and James, we each have a handful of unicorns that we've invested in over the years. Have ever done everything from kind of generalist VC to being more vertically focused around retail brands, real estate technology, as well as food and beverage brands. One of my more recent big exits that I had was a company called Beyond Meat that you might be familiar with, the plant-based protein that kind of looks like meat, tastes like meat, but not meat. So I was the largest investor in the company prior to the IPO and served on the board of directors. From a kind of vertical focus, my team is a generalist team. So we look at pretty much everything. We have 6 deal sourcing teams. We have a consumer team and an enterprise team, which are, if all we had was those 2 teams, we pretty much look at everything because you either sell to a consumer or an enterprise. But we also have 4 more vertical focused teams. We have a fintech team for financial services, a healthcare team that covers 4 sub verticals within healthcare, which is health technology, medical devices, biotech, and pharma. We have our frontier team that does advanced AI, advanced robotics, advanced materials, and space tech. And then we have our real estate team for doing commercial and residential real estate and construction technology. So cover pretty much everything with those teams. Our investment team is about now a little over 50 people. We're probably one of the largest venture teams focusing on seed and Series A investing. We have offices in San Francisco and New York. And then we have teams also throughout the United States in LA, Chicago, and Boston. And then we opened up our Asia office about 9 months ago. So we have an office in Hong Kong, as well as teams in Singapore and in India. And in Q1, I'm opening up teams in London and Berlin. So we're 50 people right now, but we'll be growing the team to about 75 in 2021. So pretty active venture group. We do about 2 to 5 investments a quarter. We look at about 20,000 companies a year, about 4,000 to 5,000 companies a quarter that we look at. And our average check size is about 100,000 to $1 million per deal. So pretty much look at everything, but I'm excited for this. I always love these sessions that are kind of ask me anything kind of sessions. And Jags and I were talking about, we would like to kind of talk about the juicy stuff and the harder questions. We can certainly ask the surface level questions and answer those as well, but hopefully make it even more fun by asking kind of some of the harder questions or thought. We'll give you kind of the hopefully somewhat of an experienced answer. And when you've been an investor, in Jags's case, is with over 50 companies, myself over 100, you've seen a lot. It's kind of like the insurance advertisement. You've seen a thing or two, and so you can kind of provide a lot of insight for a lot of different scenarios. And as a VC investor and an angel investor, you're not, there's nothing that you probably haven't seen and you're not uncomfortable in dealing with. And I was mentioning right before we joined this that sometimes it feels like the Jerry Springer show of venture and entrepreneurship. And I think there needs to be like a Startups Anonymous, where startups can just join completely anonymously and talk about the difficult things that they're having to happen. Because it's not, you'll be surprised how not unique the difficult situations are that you find yourself in. So with that, excited to kind of open up for questions.
Thanks, Sky. Thank you for that overview. And yeah, Sky and I have, come across many scenarios. And I personally had a scenario exactly a year ago where I was asking for Sky's help. And so I'll go over that in a little bit. But the first question, Sky, that I want to ask you, because this is something that I am eager to get your opinion on. So one of the company, without naming any names, accepted about $750,000 investment in exchange for 27% equity from a well-wisher, right? And with a verbal agreement, maybe a handshake, nothing in writing, etc. So at that time, it was for 27% equity. And now a few years have passed by, and now they're waiting to, they're getting ready to start, raise another round. This investor is now demanding that he not only gets the 27% equity, but also keeps, gets the $750,000 he initially invested in the company. In addition to that, as well as he is listed as a co-founder for the company. There is, this is as disappointing or as heartbreaking it can get for founders, right? Mm-hmm. And these particular team of founders are, have an amazing technology. They've been trying to resolve this since last year, 2019. So what I say to them is, and I want to see what, your opinion is, obviously, I said there are, 2 choices. But legally, I'm not sure. They definitely have to connect with their lawyer about this. But the first is you either shut down the company and restart the company. If there is nothing that we can do, there is no way you should give 27% equity in addition to pay $750,000, right? This is just not, it's going to kill the entrepreneur and the company. But legally, I'm not sure if that is something they can do because they did develop the tech using that funds. The second option is try to negotiate with them and say, instead of 27%, we'll give you 30% equity, but we cannot do $750,000 plus the 27% equity. And since you have not been really engaging, status of co-founder is not something that is going to happen, because as a co-founder, you're invested in the company's day in and day out operations and activities. Mm-hmm. What are your thoughts? Those are the 2 options I gave them. It's like, first try to make it better by just negotiating and going over this step, and then and if nothing works, then seek legal advice to see what else they can
Sure.
do.
And the thing, obviously, this is the first time I'm hearing about the situation, so I don't have a lot of backstory other than what you shared. But yeah, it's a fun situation to be in, where if the person put in $750,000 for 27% of the company based on a verbal agreement, there's nothing in writing around that. No. So that's fun. So that's one key piece of this equation, that there's nothing in writing for it. Two is that he or she is demanding the money back. That's a second fun piece of this equation. And just the fact that it's a 27% ownership is a third part. So I would kind of unpack those three different pieces.
Sure.
So one is kind of getting a better sense of who this person is. If he wants to be a founder and have the 27% ownership, but he wants his money back, I'd also be curious if he's interested in getting a vesting schedule where how much work has he even put in to get the 27%? If he's getting his money back, has he actually put in any effort whatsoever to even earn anything other than providing the capital if he's going to get that back? So if he wants to be a founder, is he willing to sign up for a 4-year vesting schedule for his 27%? And maybe the vesting schedule said you actually had to do stuff, which he didn't do, which means you might not actually get any of that 27% for the lack of doing anything. So if you're wondering what the reason is that he even deserves 27% if he's getting money back. On the side of the wanting your money back, having he's trying to think of that as like debt that's outstanding that is owed somehow back to himself. In the event that he wanted to demand that should be somehow seen as debt, that would significantly hurt the company's capability in raising their next round. I'm assuming that they've used the money to build their technology, and they're probably not sitting there with $750,000 in the bank. So unless he wants to destroy the company by not enabling them to raise additional capital, because no new investor is going to be willing to give them new money just for that money to go out the window to pay this person back. So that's the thing on the getting money back piece. And the fact that there isn't an agreement behind this, I just would want to kind of know more color if there actually really is nothing ever signed or email that stated anything around this. That's poor judgment both on the founder side and on the investor side. And so it's kind of like in divorces where both sides are probably at fault for doing stupid things. Hopefully you take that as a lesson of never doing that again as the founder either. But and again, on the 27% as a percent basis, you basically invested for, at a $3 million valuation, roughly, which is early. So again, if you were pre-revenue, pre-product, that's not a crazy valuation. So I don't think you got screwed on valuation. I think the unfortunate piece here is getting the money back. So I'll stop there, but that's my initial thoughts about how to deal with, I guess, questions of actionable aspects. Definitely talk to a lawyer. I'm not a lawyer. But if there are no terms behind it, I don't know how he can demand anything back for the money he gave you. In fact, you could screw him even more and just say, I just thought you gave me the money out of charity. We have nothing to sign behind it. If I give you any ownership, you should be lucky and bring me to court and spend, 100,000 plus and bring me to court. You can definitely do a few pressure points on that too. Worst case scenario is you could just completely abandon that company, start another company, and just say, hey, do you want nothing? Because I can give you nothing if you want nothing. And just make his equity worth nothing by stop working on that company and start a new company, and then maybe license the technology to yourself for $1. You could do some fun things like that a lawyer could probably support you in doing. So have some fun things like that. But again, it's unfortunate there's just not an actual agreement there. But again, talk to a lawyer. I'm not a lawyer, but it's an unfortunate situation. I just kind of want to almost chant Jerry in situations like this. So, try not to do that again.
Yeah. So thank you for that. And I think those are some of the things that we talked about in detail. And this particular individual, and I won't spend much time on this after this, but this particular individual has means and time and is very well connected. So that also plays a huge role.
On that piece, something that I advised you, Jagruti, on one of the situations that you had is what you could do is use this as a teaching moment as yourself as a founder. And if this investor is well connected and you're worried about reputational repercussions, tell him that you're going to draft a blog article about your experience. And if he causes problems, you'll talk about how this investor did this to your company. And as long as you're honest and you're not lying, you can use kind of writing a blog as a learning lesson for yourself to the world and showing you this person's personality.
Yeah. So I think the moral of the story for the founders on the call is that do not take money without understanding. So money is just a part of the equation, right? I mean, what kind of relationship you want to build with this person, but have everything in writing, have it on some sort of a term sheet, even if it's a plain, safe term sheet. It never shake hands, just no matter how close you are with that person. And this sometimes happens a lot with family and friends round too. I've noticed that some family and friends, they say, okay, I want the money back now. And, it's illiquid for a while, and they have to understand that when they are signing up for this. So the moral of the story is that a handshake is great, but only after an agreement is reached and signed.
Yeah, it actually just a fun little aside that I'll share. One of the LPs that I have in our fund is a professor at Harvard Business School. He teaches one of the required first classes there. And right when COVID was happening, he asked me if he could sell his LP position, even if it was at a significant loss. And I said, I could totally buy your stake out myself for like 10% on the dollar, but I like you too much. And I think you're emotionally overreacting and doing the most silly thing that people always laugh about. And so, even in downside economies, I told him that while I could probably create liquidity for him, I wouldn't do it as a friend of his. Again, you put yourself in kind of emotional situations like that. Sometimes the best decision is to do nothing. I'm glad that he still has a stake in one of our most promising companies. So
awesome.
So on that note, I'm curious, 2020 has been an unusual year. What investment trends are we seeing due to COVID, or are you seeing due to COVID?
Yeah, 2020 is so, if I compare it to the last down cycle that we had, I launched my venture career right into the last down economy, and there's definitely a lot of similarities to it. So things that you'll usually find is that from a venture asset class, funds have, for the most part, committed funds. So their investors make a 10-year binding commitment to provide capital for investments. And so when they make capital calls, they have to provide the capital for those investors to make investments. That means that usually when down economies happen, you don't have a huge death of the deployment of venture capital, because those are already committed capital funds. Where you do see the most drying up of accessing capital is from the angels and family offices, where they're kind of investing on a deal by deal basis, and syndicates are directly on their own. And so that capital tends to dry up a lot faster, and people become more conservative on cash flow on the angels and family offices. But for kind of Series A plus for traditional funds, usually there's just a normal pace of continuing to invest. And that's what we basically saw both in 08, 09, and this time around. The number of deals went down a little bit, didn't go down a lot. And then the amount of capital that was deployed went down really just from the angel seed area. But you also saw valuations continue to go up. So that it didn't stop. I remember some people were talking about valuations declining and more opportunities of grabbing 20, 30% ownership rather than 20%. That's just stayed roughly the same. In fact, valuations went up during COVID for an angel and seed round. So that was interesting. I think if I compare what happened with all the deals that we didn't stop investing. So we kept doing the same pace of investing all through COVID so far. We did see that the rounds ended up closing less than what they were hoping for. So they didn't raise as much capital, but they still closed their round. Terms were not any different from the 20% kind of general rule. So that kind of, for the most part, stayed the same. And some portfolio companies really got impacted based on the type of business they have, and other ones actually flourished during this time. So it's interesting when you think of, as a VC and as an entrepreneur, you want to be really focused on creating things that people need and not things that people want. And as long as you build a portfolio or work on companies of things that people actually need and not want, then you usually fare pretty well during all types of economic cycles. So we're really big on building a portfolio of needs and not wants. Certain portfolio companies that did remarkably well during COVID so far is we have a cannabis marketplace and an alcohol marketplace. Both of them had significant revenue growth. And both of them, surprisingly, was not because like people are just smoking more or drinking more during COVID. Both of the companies just pulled their own levers to execute a great business, but it wasn't actually positively impacted by COVID. And we validated that by looking at the average revenue of new users versus old users, and that has stayed stable. So it's not like they've had a huge increase in new customers because of COVID. Revenue from new users actually stayed stable. They've actually just pulled levers to just grow their business really well. For example, our cannabis company went from doing 3 million in March to now doing 20 million in August, and they'll end the year to 40 million run rate by the end of the year. So they've had just phenomenal revenue growth during COVID. Same thing with our alcohol company, just the massive growth in their revenue for the course of the year. But then things that are very tied to, like we have a company that does healthcare for people that want to get healthcare globally, and you have to travel to get that healthcare. They're obviously were significantly impacted by the reduction of travel, and their revenue almost went to zero in April and May. But then every month since then, they're almost back by December. They could be back pretty close to where they were in January. So they had a pretty good recovery. And that's actually been a really good portfolio company as a signaling of showing how much global travel actually is opening up, or the economy is opening up based on that portfolio company. The fact that they're almost back to where they started in January, February. So overall, pretty promising signs for going into 2021. And then again, a lot of the companies that we're investing in are pre-revenue, and they're going to be pre-revenue for another 12, 24 months. Like we have a biotechnology investments or space investments where, it doesn't matter how the economy is doing this year or next year, they're going to keep on developing. So that's kind of the quick feedback I feel for 2020. And for some companies, it'll be the year that didn't happen, where their revenues kind of stay flat and don't grow. It'll kill some companies, and other companies will just keep on flourishing.
So let me add to that, Christina, from an angel perspective, right? So a lot of the times when I am doing angel investment, my check size is, a lot lower than, what Sky does. My angel friends, the people who I usually invest with or reach out for any expertise or anything, they said, we are not investing right now. Like what Skyler said, it was, a little bit lower than other years. And the reason that they gave me is that stock market is doing so good. I can get my 2x, 3x, in stock market, in short-term investing. So I'm focusing on that. So that was one of the reasons that, especially I saw happening in the early stage angel, angel ecosystem. Another point that I want to add is acquisition. So I had invested in this company about 2 years ago, and we were they were going to get acquired by another company, not a public company, but still Series D company, with $250 million in the bank. And we went through the entire due diligence for 8 weeks. And came March 15th when things started to shut down, and they had a knee-jerk reaction. They completely pulled out of the acquisition. And they was like, you don't do that if you're a $250 million bank with a solid product roadmap and solid customer, especially if you think that this technology is going to help you. What you would try to do is negotiate it to probably better terms. So anyways, this also I experienced in COVID, in the acquisition side, that great company, great founder, great team. We did entire due diligence for 8 weeks, and they pulled out at the last minute. So that's something I personally experienced, but I also heard about that from a couple of other companies that I had not invested in, but my other friends have invested in. So I think March, April, May was totally a knee-jerk reaction time period, from investment perspective, from acquisition perspective, we all experienced that in our own life, right? So it kind of duplicated that in the investment space that that I experiest.
I also say is we've stayed away from investing in anything that is specifically COVID related for being short-term opportunities. And for one of the nice things about down economies too is that some people lose their job, and eventually that kicks them off the rock to actually start the company they've always wanted to start. And so you get the opportunity of investing in founders that never would have before taken that leap to create the company. So always looking forward again, that I think the best VCs have shown that just consistently invest every year. There's always great opportunities every year, but just make sure that they're more needs and not wants, and they're not something that is only going to be good during a down economy or up economy. That was where like the whole deal space only did really well during the down economy that lasted for a while, and then those companies, a lot of them didn't end up surviving.
Yeah.
We have a few questions coming in the chat. If we could switch over to that for a minute. So the first one is from Guru. So we are launching a product next year. What fundraising advice would you give a pre-revenue stage company?
Sure. Mainly, for pre-revenue companies, the way that you evaluate them is to make sure that you are really going after a big enough market opportunity, as well as that you have a team that can execute. So focus really on making sure you have a really clear picture of what the actual market size opportunity is. So if you were to use your revenue model multiplied by the total number of potential customers in your geographic region, do that basic calculation, because that's going to be really the main differentiator from all the deals that investors are looking at, is how much bigger is your opportunity versus others. One of the companies we just brought to our IC and we're investing in this week is a pre-revenue company. It's literally in stealth mode. The team just came together within the last 2 months. So pre-revenue, basically almost pre-team. They're closing on a $9 million round this week. And it was oversubscribed by 2 times. So they have $18 million that want to invest in this pre-revenue team that just came together within the last month or two. And the reason that it's getting so much interest is because the company has revenue potential of over $1 billion for what they're doing, and they're going after just a ginormous market opportunity. And their team members are some of the most qualified and experienced people with unfair advantage skills to be able to execute that. So again, realize that when you're going out to raise capital, the best of the funds are going to be investing in companies where revenue potential is not 100 million, which is most startups just know to send us a pitch deck where 5 years shows 100 million because they think that's what we want to see. That's the minimum. The best deals that I'm doing have revenue projections significantly over 100 million. And the good thing is it actually makes sense from a market penetration because the market opportunities are actually so large. So make sure that when you do the math, the people actually exist. I've had too many startups at the pre-revenue stage pitch me market opportunities and big revenue projections, but then if you count how many people actually exist on Earth, the math doesn't work. So just really make sure that that actually happens. I literally had that happen with about 8 years ago, a social network focused on people that like outdoor stuff. We're creating an outdoor social network, and they had in year 5, they had 90 million people on their platform in the United States. And I said, do you know the population of the United States? It's about 300 or so million. You're saying 1/3 of the US population is going to be on your outdoor social network, which means there needs to be a bigger population that you converted to get to that 90 million. So even if you said it was a very generous 10% conversion, which it's not 10%, it's lower than that. But even if it was 10%, it means you have a market size of 900 million that you're targeting. Those people just don't physically exist in the United States, unfortunately. So make sure from a pre-revenue company that you just really you're going after a sizable market opportunity to convince investors to come in, because that's really what they're betting on. They're betting on your market size opportunity and your team's ability to execute. So make sure you nail those 2 things.
Awesome. Anything you wanted to add, Jagruti, or can we go to the next question?
Yeah, no, just one thing I want to add is, Sky gave an example of this company that he talked about 18 million. That's not the story that you hear every day, right? The story that you hear every day is that, we have a product and we hope that this is what's going to be the revenue. And he said about $100 million. So I think also just to really understand not only your local market, but also global market. How can you take this, or is there a need for this product somewhere else? And a lot of times I find that the founders are saying, oh, nobody else does this. We are we don't have a great, exact competition to this. That's because you're really, your focus is really into the first set of customers. I would encourage you to look globally and look at, is anybody else doing this, and understand if they're ahead. I believe that it's great if you have 1 or 2 competition doing the same thing ahead of you, because then the market exists and they're proven it, right? And you are just going to come after them with a better better product, better this, better that, whatever it is, right? So understand, not just locally, even though you may be serving your customers locally first, but just really go global and see what else, what else is out there, who else is doing this, who else is doing this better than me, who else has a better team, better subject matter expertise, advisor, etc. And then go back and build, understand what you can do, and then go out 5 to 7 years to project that even strongly in front of investors.
I think what Jags is really focusing on right there too is that especially if you're fundraising kind of for pre-revenue, is make sure you're not pitching yourself as a first mover advantage. I think
Yes.
first time founders love to say that they have first mover advantage, but they fail to know that history is basically the winners are almost 100% the fast followers and not the first movers. And VCs know that story. So really pitch yourself as the fast follower, not as the first mover, because unfortunately, it's really hard to come up with any companies that have been the big category leaders that were the first movers. So first movers usually educate the market. The market learns what they're doing, iterates on that, raises more money, and then shoots the first mover in the back and kicks their butt. So don't be the first mover. So stay away from that as a first time founder. A wrong thing to say, but it sounds like the right thing to say. But as you kind of get more experience, you want to be the fast follower, not the first mover.
Right.
Great. The next question comes from Christine. So she's asking around timing for starting fundraising conversations. So with holidays coming up, end of year can be a terrible time to begin conversations. So for companies planning to start their raise in January 2021, what do you do to stand out, or are you competing for VC attention? Can you speak a little bit to how to get VC's attention, timing, conversations?
Sure. I think a lot of VCs are always investing. So I don't think we stop. In my over a decade of VC investing, I've never taken a pause in August. Like some people take vacations, I guess. I have a lot of venture. We're just always investing. So, I don't think that holds true. Same thing. Like I have meetings tomorrow. I have meetings on Friday. I didn't do any meetings on Thanksgiving, but like I got meetings before and after. And next week I'm completely filled up as well. And I'll be booking all the way through December. So, I think it's you that's deciding to maybe psychologically get yourself like, oh, maybe I can take a break. Just don't take a break, because I don't think the VCs are either. At least I know my team's not. So just always be pitching. I think to get our attention, it goes back to, I really like to find founders that have unlocked something about the market in their approach. So historically, also, if you look at where successes come from, it's not because of technology, it's because of innovative approaches and business models than it is actually technology. So I almost never invest because of technology. So what is that innovative approach where you've unlocked a secret about the market? And oftentimes it kind of falls into this kind of interesting logic where it can be situations where it looks like a terrible idea, but it's actually a good idea. And it looks like it's actually a good idea because you've unlocked that secret. But the challenge is when you go after bad, it looks like bad idea, but it's actually a good idea. The challenge is bad ideas also look like bad ideas as well. So you have to make sure it's not one of those. But going after good ideas look like good ideas, like everyone's going after those things. So what is going to be your kind of unique perspective on unlocking a market that nobody else has really figured out, or maybe in that unique approach? So I think we're always looking for that extra insight where it may not always be obvious. And if it is obvious, you really have to make sure you can answer two core questions, which is what is your unfair advantage and what is your sustainable advantage? Again, first mover advantage is not unfair nor sustainable. It's just a first mover, which you lose that pretty quick. So what is your unfair advantage? And there's lots of different types of unfair advantages. And what is your sustainable advantage? And there's lots of different types of those. So have a good answer for those, because a lot of entrepreneurs have not put enough time into figuring out the various things that they have now or can develop in the future to create those competitive moats. Again, all of that is conceptual. You can be a totally pre-revenue, pre-product company and still have answers to those questions.
Yeah. One thing I would like to say is that I always encourage I like to see actually and encourage entrepreneurs to have a slide on what differentiates us, right? And it's not a first mover. It's not that we have a great team. The team should be able to execute what differentiates you. That's on the slide. But usually, most of the time, the entrepreneurs go from a problem statement to solution, and then how they're going to penetrate the market, and with this, they have the best team, and et cetera, right? I rarely see the slide focused on the two things that Sky mentioned, that talks about what is different about what we are doing. It might be the old idea, new technology, whatever it is, but what differentiates us? And it's not your team, and it's not your first mover advantage.
And it's
So
not
you
your
really have to think about
either.
that.
Yeah.
Sorry?
And it's not your technology either, because it's like, again, everything can always be iteratively better. So
Right. Either you are increasing the productivity for your customers, or whatever it is. And that slide should also focus on how does it not help you think you're different than the other, but how does your customers, even if it's a future customer, may see this as an opportunity to do business with you, because this differentiates you from your competition.
Yeah, I'd say the last thing I'd touch on that is the why I focus a lot more on differentiated business model approaches than technology is assume that someone else could copy everything that you're doing. What is it going to be about that approach that makes you more capital efficient? Where everyone can do businesses, business models. There's only a certain number of different types of business models in general that exist of how you can generate revenue. So what is it about that are going to give you higher scalability, where you put money in on one side and more money comes out on the other, and you do that in a way that is more scalable than someone else replicating your business? And that becomes a big differentiator, is just a higher capital efficient, unique business approach that may have an unfair advantage to being able to achieve that. So again, if you have two different companies, equal business models for the most part, but one you put in more money and more money comes out on the other side than the other, everyone's looking to build an engine where that's the goal. At the end of the day, don't forget that you are building an engine where that's supposed to happen. Put in money on one side and more money is supposed to come out on the other side.
Yeah, and one quick example on that is a company called Waiter. I remember Waiter was competing in the San Francisco Bay Area with DoorDash and other delivery. I think DoorDash was the main one, and Uber Eats. What they decided was there was one differentiation that I really liked, is that we are not focusing on the coastal cities. We are going into the Midwest. And the geographical differentiation actually paid off very well, and they did very well, and they got acquired. They didn't have a different business model, they didn't have a different technology, but they chose to focus on a different geographical area. So that is also something that a lot of times is a great thing for you to quickly grow into an untapped market.
Yeah, you bring up location as an example of an unfair advantage. So if you have a restaurant on the corner in the center of a town, you typically outperform. So location can be an unfair advantage physically, because not everybody can have the same corner for where their store is. So having a geographic focus and limited resources, you have to choose where you're going to play and where you're not going to play. So location is definitely an aspect of an unfair advantage.
Yeah.
Awesome. So we have another question here from Alicia, and I think really what she's getting to here, Sky, is if you can speak to a little bit about the way investors or VCs think about the deals that they're going to do. So her question is, for example, you have a meeting with an investor. They say that they'll talk internally and circle back with you. Can you speak to what is typically happening behind the scenes?
Sure. Yeah, absolutely. So we have on Fridays a meeting where each of our deal sourcing teams meet by themselves, and they discuss all of the top deals that they met with that week. And then they decide what the top 2 deals are that each of those teams met with. And they bring those 2 deals to the partners meeting on Mondays. So basically, you're being competed against all the other deal flow that particular deal sourcing team reviewed that week. So the reason that we might not be moving forward with you is maybe nothing to do with the fact that you don't have a good business. You might have a fine business. It's that you were being competed against lots of other companies that were going after completely different markets than you, potentially going after likely bigger markets than you, with better teams, capability of executing, and with maybe higher quality investors around the table with deeper pockets. So that's usually the reason that you're being passed on. Even if you do have a good company, it's just that realizing that there's better markets and better teams than you. And we have to be picky. So we invest in 0.1% of the deals that we look at. Most venture funds invest in 1%, where you invest in 0.1%, given the volume of deals that we look at. But yeah, you're being really competed on market size, team's ability to execute, unfair and sustainable competitive advantage, who the other investors are, and do you have kind of a unique business model approach that can give you kind of additional scalability. Those are typically the top 5 things. We have an investment evaluation sheet that I'm happy to send around to everyone afterwards, but internally we use an investment evaluation sheet that has 14 criteria. Each of those 14 criteria have a handful of questions. So you could review that on your own and answer the questions yourself to see how you stack up to when we're evaluating all these companies. And then out of those 14 criteria during the partner meetings on Mondays, I focus really on 5 of those versus the 14, just to kind of focus in on the things that really matter the most. But happy to share that. It's an internal thing that we use for evaluating, and a lot of other angel groups and other venture funds have now adopted this evaluation sheet that I put together about 8 years ago. But it's a great resource to kind of do a self-evaluation of your own company.
Yeah, and I use that, Sky, all the time too, when I'm looking at a company on my own, as well as I've actually shared that with some of the people that I worked with at Communitech as well. So thank you for that.
Sweet.
Yeah, we'll definitely share that out to everyone following the call and make it available to those watching the video after as well. So the second part.
Can I just say one more thing to what, and if you get denied, right? If they say we're not interested in you, investing in you, don't think of a closed door as a closed door forever, right? Stay in touch with the investor and also ask if there anybody else they can introduce you to in their circle who may be interested in something that you have, and expect that you may not get that answer, but always leave that door open. Closed door right now doesn't mean it's closed door forever.
Yep. And sometimes you can also use the meeting with venture funds to get customers. So look at their portfolio companies to see if you can get any introductions to portfolio companies that could become customers of yours as well.
That's great advice. The second part to Alicia's question was asking how entrepreneurs could mitigate their risk during those conversations. And then you also gave some great tactics to.
Yep. Yeah. Make sure you really do look at the portfolio before you pitch the fund. Like, we might be investors in a direct or indirect competitor. So definitely look at our portfolio before you send your pitch deck to us, because I already have allegiances to my portfolio companies. So don't make that mistake. And also realize that we get pitched so many things all the time that you can really use the opportunity to talk to the VC just to have a nice open conversation too about what's other things that they've seen where there's maybe smarter approaches, maybe that have been used in other verticals, but use it as a way that because we see so much, you can just learn from how we think about markets, and that might help modify what you're doing to create a bigger opportunity. I have one of our companies that we're going to hopefully invest in next week. I have been helpful in strategically getting them to think about creating a whole new part of their business that they weren't even focusing on before. And if I join the board of directors, that'll be one of my core focuses in helping them build that out. And they just weren't even considering that when I first got pitched them.
Great. The next question is asking, really, how does a company know whether they should be seeking Canadian investment or US investment? So for example, they're founders of a social network for bartenders. So, if a company is really looking at themselves and what they do and where their market is, how do they know which type of investment to go after?
Yeah, so venture funds, some have geographic focuses. So obviously don't focus on the ones that don't invest. If it's a US fund, don't focus on the ones that don't invest outside of the US. We invest globally everywhere. So we're geographically agnostic. But yeah, make sure that it makes sense for that investor to even consider the investment. Where you think about value-added capital, other than the check itself, there's a few different types of value-added capital. One type of value-added capital is just capital that's access to a lot more capital. So deeper pocketed capital is obviously a nice value add. So you could take capital from people that can only invest once. You can take capital from people that could lead your next round or participate in the next multiple rounds because of the size of their fund. So those are always more attractive investors to bring on. And then you certainly have ones that have expertise in investing in your space, who have kind of seen various versions of things succeed and fail, that can help you strategically, and maybe they have types of portfolio companies that are relevant for what you're doing. So getting experienced investors in your vertical is always great. That also lends itself to more introductions and a more powerful network that can help you. But yeah, I think those would be my main focuses. Is just really most VCs differentiate themselves on the value add, mainly on their ability of their power of their network, and their ability to give you more money in the future. Those are usually the only two real types of value add. And most VC, well, almost every VC says that they're a value add investor. Most of them are not.
Yeah.
And I think the other thing is you have to focus on do no harm. I think that's one of the, I think every VC should make an oath about doing no harm when they invest in a startup, that we're just here to help. I do everything possible just to help my portfolio companies. And if things aren't going the way you planned, well, that's normal. But don't make it harder for the founder. Just figure out how to help them.
And another thing that, Sky, that, a lot of times that I find that if they're interested in, let's say you find a VC that, is interested in investing in you and want to come on board and have a board of director, want to be on the board, ask who's going to be on the board. A lot of times, sometimes one time I had a company that thought that the investor who's investing in a lead investor is going to be on the board, and he ended up sending somebody else who's junior on the board. And that's like, you're wasting a board seat, right? I mean, so make sure that you also talk about that if you have a multiple, interest from the investor. And I just want to ask you a question following on this, Sky, is that I've also heard from from entrepreneurs that how long do I have to do the dance, right? I get the individual lead investor who's interested in me, and they send me a whole bunch of questions, and I send the answers, and then they want to meet again, and then they say, okay, we're still thinking about it. So it's like, and in the meantime, entrepreneurs like, are you going to come in or not? I mean, we've been dating for 4 weeks already. What's your answer, right? How do you gracefully exit that relationship, knowing that they might be interested in the follow-on round?
Sure. Yeah, I think it depends if you're talking to a lead versus a co-investor, for how much time you should probably dedicate to them. If they have the potential to be a lead, you definitely want to give them more love. And also depends on how attractive of a startup you are. If you're not, pushing away money, then unfortunately you have to take every date that you can do, and you have to keep on going on all these dates. But if you're super attractive, you only have to date for a week and you close your whole round. So it really comes down to how attractive you are, of how fast you're going to close that deal. So there is an attraction level here. The difference, though, between dating and marriage and investing is you're kind of looking to ultimately find a very successful divorce situation, because you're going into it knowing that you don't want to be married the rest of your life together. You're hoping to build assets together, and you want to separate within 5 years, but both having lots of money together. So it is a kind of going in for making sure you have alignment of incentives, that we're only doing this for hopefully 5 to 10 years, and then we definitely want to separate, but happily so. So to make sure that there's an alignment of interests of both sides are knowing what they're getting into. The other thing I would say is, just like dating, most of the stuff you learn is only after you invest. Just like most of the things about people, you only learn after you start living with them or married to them. So you'll never learn everything during due diligence. Everyone has skeletons, and the more you learn about any person or any company, you're probably not going to want to invest.
Another question here from the chat. Is having patented technology or IP a prerequisite for investment? Is it necessary?
No. Yeah. So in only a very few segments of venture is patents actually super useful. Patents are definitely more of a defensive strategy, not an offensive strategy. Again, we're investing in companies not because of technology, but because of abilities to execute on that opportunity. For example, the company I'm investing in this week that has the $18 million of interest for the $9 million round that's pre-revenue, and the team just came together 2 months ago. They have no patents whatsoever, but there are other companies in their space that have patents that we've spoken to. Those companies have great engineers and R&D people, but they're never going to execute the opportunity. And they also don't have access to investors that have really deep pockets like this company does. And so I'd rather take subpar technology with a team that can execute than the best IP in the world. Eventually, we could buy that IP, we could hire those people that have the IP. All that's nice, but just focus on execution will always win. And so focus on that.
Okay, good advice. Another kind of a specific question here. So a business angel has signed a SAFE with a 2.5 million cap on our post-product pre-revenue startup. As we are preparing for a 2 million seed round mid-2021, we need a bridge. Is it feasible to sign a SAFE with no cap with new business angels for this bridge?
Yeah, if you don't like investors, you can definitely do no cap. Like if you really are just looking to screw investors, no caps are fantastic. They're not looked favorably upon by the investment community, and it looks more piggish from how the founder is thinking about it. The cost. So the reason that SAFEs exist in convertible notes versus preferred equity really came down to speed and cost, right? Your average cost from a main law firm will do a SAFE for $2,500, a convertible note for $5,000, and a Series A for like $10,000 to $20,000. So when you're raising small amounts of money, that difference in cost makes a difference. In general, investors really prefer not doing SAFEs. Your 2.45 million cap is really, really low. So hopefully you're raising a relatively small amount of capital for that 2.5 million cap. In general, depending on how much runway you're raising, if you're shooting for like a 24-month runway at a pre-seed, then maybe you're giving away up to a third of the company, but just be mindful of that 2.5 million cap. But if you're preparing to do a 2 million seed round in mid-2021, I guess the question is the capital you're raising, how long will the capital you're raising now last you? Every round you raise should ideally last you 12 to 18 months. If you're raising a round of capital that's only going to last you 3 to 6 months, I'd highly advise you not to do that, because you're going to be too distracted raising capital, executing, raising capital, executing. So you just put yourself into a really bad cycle. So I'd rather have you, raise more capital now at a higher cap, and give yourself 12 months of a runway to kind of go out to raise the next round. But try not to do SAFEs. The other thing, again, why SAFEs and convertible notes screw investors is that you're not creating an employee option pool in that round. So if you come in on a SAFE or convertible note, when I convert in the next round, that's when the employee option pool will actually get created in the price seed round or the price Series A. So you're getting double dilution for the convertible note, the SAFE, and it's all, you kind of as founders don't care as much, but for us investors, we definitely take that into consideration. I'd rather, convertible notes, the extra 20% discount is usually not worth the additional risk. I'd rather just wait until the actual price round happens when you're closing a lot more capital that'll allow you to achieve even bigger milestones. But I would say is signing a SAFE feasible with a no cap? Yeah, you can do. There's a lot of stupid investors out there that are willing to do anything. So if you can get it, it's good for you. I don't think you're going to get the most sophisticated investors. If you want to get a bunch of people that are willing to do that, I question on your capability of closing on really great investors.
Ditto.
We're reaching close to the top of the hour here. We have about 5 minutes left. So last call to the audience. If you have any other burning questions that haven't been answered yet by Jagruti or Skyler, put them in the chat now, and we'll get to as many of them as we can. And while we're waiting for more questions to come in from the chat, thank you both for being here today. And I wondered if you had any kind of last minute final thoughts for the group as far as what would be a key takeaway from today's session.
I'd say, we haven't figured out immortality yet, so you use your time wisely in what you choose to create. And I think oftentimes founders don't compete like 50 different ideas against each other to find the one idea they're going to start. Usually founders are limited in how many ideas they have. And so they think of like one idea and that's the company they start, when there could have been way better uses of their time if they competed against 50 other potential ideas, or joining other companies that have already been created. So I think VCs have the wonderful privilege of seeing lots and lots of things before they make an investment. I think founders should be a lot more careful about what companies they choose to create, and just be more competitive about how you're using your time. Because you could start and fail a company every 6 months. So there's a certain number of startups that one could create during their lifetime when they're willing to kind of go down that path. But just use your time wisely, because we're not getting any younger. So at least not yet. I'm trying to find longevity companies to invest in, but
We tried it once, remember?
say again?
We tried once.
Yeah, well, and to be fair, I haven't made an investment. I am on a longevity medication, but I haven't found one to invest in yet. But I think that's one thing I would share, is just really have a really high bar for what you're doing, and create something that's really inspirational, and don't just create the first kind of concept that you think is good.
Yeah, and once you have created that inspirational and the idea that you want to dedicate next 10, 15 years of your life, I suggest that when you are when you are going in front of investors, interview them as much as they interview you. So I actually have a set of questions that I want founders to, even if they don't ask directly, consider before taking money. And I can forward that to you, Christina, as well. And those are, things like, what percentage of your term sheets turn into checks? Like, you want to know, will you be doing follow-on round? What other value will you bring? What is your timeline? And a lot of times, founders are like, okay, I have to make sure that I don't ask a difficult question because I'm afraid that I may turn off the investor. If you turn off an investor because you have a question, that's not the investor you want. There is a one that will fit better into your, what you're asking. So I'm happy to forward that as well, Christina, to you. But that would be my advice, is that do your due diligence, know what the portfolio companies they've invested in, and how can they be of help, not only in this round, but also in the future rounds.
Yeah, maybe last, also just things at top of mind over the last month or two. I shared with our team, I kind of I geeked out on the concept of the Pareto principle, which is the 80-20 rule. And what I was blown away by is that it wasn't just a coincidence that things are often in this 80-20 ratio, and really following power curves, which is really the core of the Pareto principle, is a power curve. But I was fascinated to learn over the last few months that it's not just a human social law, it's actually a mathematical law of the universe. And so the more I've dived into that, I've been blown away by actually how powerful distribution curve logic is. So if you want to apply it to your life, we all have to-do lists, and we all have to-do lists that never stop, which they just get longer. Just focus on prioritizing your top things on your to-do list, and just focus on getting the top 20 highest priority things done, and don't worry about the other 80% ever getting done, because those are the things that'll move your life forward the most. So have some comfort knowing that you only need to get the top 20% done to make 80% of the difference for your life.
That's good. That's good advice. Thank you. Just for everyone left on the call, I know some people put into their pre-questions, they had questions about government funding as a way to also to fund their business. And so we will be running an Ask Me Anything session around what government funding is available in Ontario. And that will be on December 15th. So watch out for registration information for that if you're interested in learning more about IRAP, MyTax, and all of those pieces. And with that, I'd really like to thank you, Skyler, and you, Jagruti, for joining us today, for making the time, and for answering all of our questions. Really appreciate it. And thank you to the audience for joining. Stay safe, be well, and we'll see you next time. Thank you.
Thanks, everybody.
Bye.